Where's the market going? Oh my gosh, the world's on fire. The biggest question that we're getting right now is what's happening in the market, and it's really the interest rates going up has definitely affected where we're going right now, and it has drastically shrunk the buyer pool. Instead of putting a house on the market and getting 5, 10, 15, 20 offers on a house, we're basically sitting at a point where some of the homes that are going in and trying to get top dollar and push the market a little bit further, we're getting pushback on those. What we're seeing on those is we're getting one offer, two offers. We're back to a point where we're negotiating back and forth with price and terms and all that stuff. So the people that are pushing the market and trying to get that ridiculous price that we were getting a few months ago before the interest rates started going up are just not there anymore. We're at a point right now where you really have to be cognizant of where the real value of your house is. The people who are pricing their home correctly for sale are seeing multiple offers still. They're getting terms and conditions that are more favorable to the seller, and they're able to really get the best offer for them and their family and move on and find another house. Really, right now the market is in a little bit of a weird time. I would say that the interest rates going up has just kind of flattened the market out. We were at a point where we were gaining so much value in a year's time where that just isn't normal. As a homeowner, it's awesome because you're like, yes, I have all this on paper, I have all this value in my house, I have a ton of equity. My house is worth way more than it was when I purchased it. But in reality, like, a healthy market is like 3% growth. I mean, if it goes a little bit higher, like 5-6%, like, you're still in a healthy market right there. And that's really where we should be. And that was kind of the idea of the interest rates going up so high, and the Fed raising the federal interest rates is to essentially slow spending and slow the growth of the economy. I mean, it sounds kind of counterintuitive, but where we're at right now, 5%, 6% interest rate. I've been saying this for a while, like that's where it needed to go. But like the fact that it went there so quickly really has kind of stifled the real estate market a little bit, but it's still a great time to buy. I mean, and the values are still going to go up in over the next 5 years, in my opinion. I mean, when you really look at all the data, we do have a lack of inventory and there are still a lot of buyers. And when people get to the point where they realize that this is the new normal, they're going to jump back into the buyer pool. I mean, maybe their income goes up, maybe they save a little bit more money, they can put a little bit more money down. But I mean, the fundamentals behind it are still there. Real estate's always been a thing, like supply and demand. Like that's how real estate markets always run. Like the less supply there is, the more demand there is. I mean, that's just simple economics at this point. I mean, it's been a little weird, but I mean, at the same time, like in the market to purchase a home, don't hesitate. It is a great time to buy. And the reality is the interest rates will probably come down at some point. So if you purchased it and you're sitting at a 6% interest rate, I mean, who cares? Like you refinance it when the rates come down, and all of a sudden now your payment's at a point where it's more reasonable, and now you've gotten used to that higher payment, and now you're getting a lower payment. You're able to save more money, do more things, maybe go on that vacation, or maybe invest in another property. So there are a lot of different things that you can do in order to combat the interest rates. Right now, I'd be looking at ARMs, adjustable rate mortgages. They have 5-year, 7-year fixed rate mortgages, and then they adjust after that period, and they're all based on 30-year amortization. So it's the same as your payments are going to be are actually going to be a little bit less, because you're basing it. The interest rates are right now on those products are a little bit lower, but I mean the risk is there. I mean there's no guarantee that in 5 years that their interest rates aren't higher than where they are, but you really just have to look at what your plan is. Like everybody's plan's different. Like I know just me personally, I don't ever plan on staying in a house for a long period of time. So, a 5-year ARM may make sense for me. I can justify that risk and just know that in 5 years. I have to look at what the market is, refinance it, or I can sell my house or do whatever. I mean, so like there's different options out there, and it really just is what makes the most sense for you and your family. I'm sure there's a lot more questions out there. So if you do have anything else that you want to like talk about or just go over, feel free to reach out to us. I mean, we're happy to talk. This is what we do every day. We're in it, we watch it, we feel it. I mean, we can tell when the market's making a change and see it when it's happening. If you do have any questions, don't hesitate to reach out to us. Talk to you soon.